Did you know that Warren Buffett, one of the richest people in the world, actually pays a lower tax rate than his own secretary? This might sound surprising, but many wealthy people in the U.S. pay very low taxes, or sometimes none at all. They achieve this by using specific tax breaks that are available under U.S. tax laws. The great thing is that you don't have to be a billionaire to benefit from these tax breaks. Many of these strategies can be used by anyone, not just the ultra-wealthy. Here are 8 common ways that rich people reduce or avoid paying taxes. Remember, these tax-saving techniques aren't exclusive to the rich. Regular people can also take advantage of them to save on their taxes. Let's dive into the first point. But first, please hit the thumbs up button below and subscribe if you haven't already. To lower your taxes, one of the best strategies is to maximize your deductions. Hiring an accountant can help you do this effectively. Their main role is to identify all possible deductions to reduce your tax burden. This is especially useful if you own a business, have a side hustle, or work as an independent contractor, as you have many more deduction opportunities compared to a regular employee. For a standard employee, the financial cycle is straightforward. You earn money, pay taxes, and then spend what's left. But for business owners or independent workers, the process changes. You can spend money on business expenses first and only pay taxes on what remains. The government encourages investment in personal growth and business ventures by offering tax incentives. For instance, if you use items like a cell phone or computer for your business, those purchases are deductible. This means you can deduct these costs from your taxes because they are necessary for your business operations. Expenses related to business activities, such as meals with your team or travel for work, can also be deducted. For example, if you travel to create content or attend a business event, costs like flights, hotel stays, and meals are deductible, reducing your taxable income. To make the most of these deductions, ensure they are for business purposes and contribute to business growth. Not all expenses are fully deductible, so consulting a tax professional is crucial to navigate these rules correctly. A specific tax benefit is found in Section 179, which allows you to deduct the full cost of business equipment, including vehicles over 6,000 pounds in the year of purchase. Normally, you'd deduct a portion of the cost over several years, but Section 179 lets you deduct the entire amount up front. This provision was particularly advantageous in 2022 for heavy vehicles like a G-Wagon. While this can be a valuable deduction, it's important to discuss with your tax advisor before making any purchases solely for tax benefits. For instance, while a G-Wagon could provide significant deductions, it should only be purchased if it aligns with your business needs. Personal spending should focus on investments that contribute to long-term business growth rather than just seeking tax breaks. Another way to reduce your taxes is by investing more aggressively. Investing is a strategy everyone can use, whether you have a lot of money or just a little. It helps build wealth and provides tax benefits. You don't need to be a millionaire to benefit from investing, but you do need to invest wisely. Here's how it works. If you buy a stock for $100 and sell it for $200 within 3 months, you've made a profit. However, if you sell it before a year has passed, you won't get any special tax benefits. The IRS views investments held for less than a year as short-term, and the gains from these are taxed the same way as your regular income. For better tax breaks, hold on to your investments for over a year. This qualifies you for long-term capital gains rates, which are lower than short-term rates. If you hold your investments for longer than a year, any profit you make may be taxed at a lower rate. For example, if you earn $40,000 from a job, you'll pay federal taxes, state taxes, and other deductions, which might leave you with about $32,000. But if you invest your money and make a $40,000 profit from investments held for over a year, you could end up paying little or no long-term capital gains taxes, depending on your income level and tax bracket. In some cases, you might even pay 0% on your gains, leaving you with the full $40,000. In 2022, the highest tax rate on long-term capital gains is 20%. So if you make $1 million from investments, you'd pay a maximum of 20% in taxes on that gain. This could be significantly less than what you'd pay on regular income, making long-term investments a valuable strategy for reducing your tax bill. By the way, if you're finding this video helpful and want more content like this, Comment more below. Let's keep going. Another way to reduce your taxes involves selling your home. If you buy a home for $250,000 and live in it for 10 years, and then the value increases to $400,000, you can sell it for that amount. The profit from this sale can be up to $150,000, and you won't have to pay taxes on it. This is a great tax break available to homeowners. If you're single, you can make up to $250,000 in profit from selling your home tax-free. If you're married, you can make up to $500,000 tax-free. You can use this profit to buy a larger home or invest in something else. To get this tax break, you must have lived in the home as your main residence for at least 2 years before selling it. You can't just live there for a few months and expect to get the tax benefit. If you're unsure whether you meet the requirements, it's a good idea to talk to a tax professional to make sure you qualify and avoid any unexpected tax bills. Another way to legally avoid paying taxes is contribute to retirement accounts. Reducing your taxable income through retirement accounts is a highly effective strategy. Contributing to accounts like a 401k or an individual retirement account (IRA) can significantly lower your taxable income and, consequently, the amount of taxes you owe. With traditional 401ks and IRAs, contributions are made with pre-tax dollars. This means that the money is deducted from your paycheck before taxes are calculated, thus reducing your taxable income for the year. For instance, if you earn $50,000 and contribute $10,000 to a traditional 401k, your taxable income would drop to $40,000. Additionally, some retirement accounts, including traditional 401ks and IRAs, offer tax-deferred growth. Investment earnings in these accounts grow without being taxed until you withdraw them in retirement, potentially allowing you to pay taxes at a lower rate if you are in a lower tax bracket when you retire. On the other hand, Roth IRAs operate differently. Contributions are made with after-tax dollars, meaning you've already paid income tax on the money you contribute. However, withdrawals from Roth IRAs are tax-free in retirement, providing a source of tax-free income later in life. Both traditional and Roth retirement accounts can be instrumental in managing taxes and planning for the future. By understanding and utilizing the benefits of each account type, you can reduce your taxable income, defer taxes on investment gains, and possibly benefit from lower taxes in retirement, helping you achieve your long-term financial objectives. Another way to legally avoid paying taxes is by using debt strategically. Here's how it works, using Elon Musk as an example from 2021. Musk is very wealthy but doesn't earn a salary from his companies, so he avoids income tax. In 2012, Musk received stock options for Tesla that became valuable in 2021. This was the first time in years he had earned money, so he faced a large tax bill. Since he didn't have enough cash to pay the taxes, he asked his Twitter followers whether he should sell some of his stock to cover the tax bill. Even though Musk is rich, he doesn't keep much cash because he relies on the value of his Tesla shares. To avoid selling shares and paying taxes, he borrows money against them. For instance, if his shares are worth $1 million, he can take out a loan for $500,000 using the shares as collateral. This way, he gets cash without selling the stock or paying taxes on the borrowed funds. This method works well, especially when interest rates are low. For example, if the interest rate is 4% and his stock grows by 10% a year, he benefits from the increase in stock value while only paying a small amount in interest on the loan. Similarly, if you borrow money to buy a house, you don't pay taxes on that borrowed amount because it's not considered income. By borrowing against his Tesla shares, Musk gets cash while keeping his stock and its potential value. He can pay back the loan over time with interest, but continues to benefit from the rising stock price. Many wealthy people use this strategy to maintain liquidity and avoid taxes, living off the borrowed money while their assets appreciate. Robert Kiyosaki, author of Rich Dad, Poor Dad, also uses this strategy. He says that borrowing money allows him to avoid paying taxes, and he believes that debt can be beneficial if managed wisely. However, it's important to be cautious with debt because borrowing too much can be risky. If the value of your assets drops, you might struggle to pay back the debt. So if you choose to use debt to manage taxes, make sure you understand the risks and handle the debt carefully. Another way to reduce your tax bill is to minimize your earnings. a strategy often used by wealthy individuals. The IRS taxes you based on the money you earn, so if you can show that you didn't make any money, you won't be taxed on it. For many wealthy people, this means they avoid earning income directly. Instead, they make money from investments and assets. When you earn money from a job, it's taxed immediately. However, if you own a business, you're taxed on your profits, not your total revenue. So if your business makes $100,000 but you spend all that money, you end up with no taxable income. A few years ago, my accountant informed me that I faced a significant tax bill unless I spent more money. I needed to find a way to spend $300,000 in my business to reduce my tax bill. Spending money strategically can help lower taxes without wasting it. You don't want to spend money just for the sake of it, as that would be inefficient. Instead, you should spend on things that benefit your business and help it grow. This way, you invest in your business's future and reduce your current tax bill. For example, spending on consultants, classes, or marketing can improve your business and help you earn more later, rather than just giving money to the IRS. Many businesses and YouTubers follow this approach, especially toward the end of the year. They spend more on advertising and other business expenses to lower their taxable income. This is why you might see more videos from YouTubers in the last months of the year. They're trying to capitalize on higher advertising revenue. In contrast, during the first months of the year, spending decreases, leading to less income for YouTubers as companies cut back on advertising. Another effective way to manage your taxes is by investing in real estate. Here's how it works. Imagine you buy a property for $100,000, not to live in, but as an investment to rent out. If you can rent this property for $1,000 per month, you'd make $12,000 a year in rental income. However, you have costs to consider. Suppose you spend about a third of your rental income, around $4,000 a year, on expenses like property taxes, insurance, maintenance, and management fees. This leaves you with $8,000 in profit. If you finance the property with a mortgage, you might borrow $80,000. Your mortgage payment could be about $400 a month, totaling $4,800 a year. After paying this mortgage, you end up with a profit of $3,200. This $3,200 is your taxable income, and you need to report it to the IRS. However, as a real estate investor, you can benefit from an additional tax advantage called depreciation. Depreciation allows you to deduct the cost of the property over time, even if the property's value is going up. For example, you can claim a tax deduction for depreciation of $3,600 each year, calculated by spreading the cost of the property over 27.5 years. This means on your tax return, you can report a negative income of $600, the $3,200 profit minus the $3,600 depreciation deduction. Effectively, this can reduce your taxable income to zero, even though you have $3,200 in your pocket. This depreciation benefit helps many real estate investors, including high-profile individuals like Donald Trump, to earn significant income while minimizing their tax payments. Additionally, if the value of your property increases to $200,000, you can refinance and pull out an extra $100,000 as cash, which you receive tax-free. This cash can then be used to buy more properties, generate additional income, and create further tax deductions. Financial education plays a crucial role in understanding and utilizing these tax benefits. If you're currently only working a job and feel you can't afford real estate investments, start by learning more about finances. You don't have to dive into real estate or start a large business right away. Even starting a small side hustle can provide additional income and tax advantages. If you are interested in real estate, begin by saving a bit each month towards your first rental property. If local real estate prices are high, consider looking in more affordable areas such as the Midwest, where properties can be purchased for around $100,000 and still provide good returns. With the right knowledge and effort, you can achieve your financial goals and take advantage of these tax-saving strategies. The final strategy involves selling your real estate investment. For example, if you bought a property for $100,000 and its value has risen to $200,000, you would make a $100,000 profit. However, this profit is taxable. To avoid paying taxes on the profit, you can use the money from the sale, $200,000 in this case, to buy a larger property using a 1031 exchange. also known as a like-kind exchange. This method lets you delay paying taxes by reinvesting in another property. This not only helps you avoid immediate taxes, but also can improve your cash flow and increase your tax benefits. You can keep using this strategy over time. As property values go up, you can keep upgrading to more valuable properties, continuing to delay taxes each time you reinvest. For instance, if you upgrade from a $200,000 property to a $400,000 one, you can keep growing your investments without paying taxes on the gains, thanks to the 1031 exchange. The 1031 exchange is a popular tool among wealthy investors. It allows them to grow their wealth and rental income while deferring taxes by investing in properties that appreciate in value. If you enjoyed this video, give it a thumbs up and share your thoughts in the comments. For more informative content on finance, entrepreneurship, and self-improvement, subscribe to our Voice of Wealth channel. We post new videos every other day to help you succeed in various aspects of life. Have a great day and see you in the next one.